The phone call arrived at 3:14 a.m., shaking the foundations of global finance. It wasn't a warning, but a desperate plea from Credit Suisse, one of the world's largest banks, to unwind billions in exposure. The counterparty, a virtually unknown family office named Archegos Capital Management, run by a man who had already been banned from the securities industry. This wasn't a rogue trader, nor a corporate giant's collapse. This was a single individual, operating with staggering leverage and minimal oversight, whose actions would trigger a fire sale of over $30 billion in assets, rattling Wall Street and exposing critical vulnerabilities in the financial system. At the heart of this storm was Bill Hwang, a man whose journey began far from the gleaming towers of Manhattan. Born in South Korea, Hwang arrived in the United States with an ambition that would eventually lead him to the highest echelons of finance, and then, spectacularly, to its precipice. His early career saw him hone his skills under the tutelage of Julian Robertson, the legendary founder of Tiger Management. Robertson, known for his keen eye and aggressive investing style, saw potential in Hwang, a devout Christian who often spoke of his faith. Hwang would eventually launch his own hedge fund, Tiger Asia Management, in 2001. For years, the fund posted impressive returns, making Hwang a formidable player in the competitive world of Asian equities. He became known for his aggressive, often short-term, trading strategies. However, this success was marred by controversy. In 2012, Tiger Asia and Hwang faced charges from the SEC for insider trading. The allegations centered on trading Chinese bank stocks using confidential information. Hwang pleaded guilty on behalf of Tiger Asia to wire fraud, agreeing to pay over $44 million in penalties and forfeitures. Crucially, he was also banned from managing other people's money. It was a significant blow, but not the end of his financial career. Instead of fading away, Hwang pivoted. He transformed Tiger Asia into Archegos Capital Management, a family office. The distinction was critical. Family offices manage the wealth of a single family, meaning they operate with far less regulatory scrutiny than traditional hedge funds. This lack of oversight, combined with Hwang's aggressive tendencies, would prove to be a dangerous cocktail. Archegos began to grow, quietly amassing enormous positions in a select group of publicly traded companies, primarily in media and technology. Hwang employed a sophisticated, yet inherently risky, strategy: total return swaps. These derivatives allowed Archegos to gain economic exposure to a stock's performance without actually owning the underlying shares. This meant they didn't have to disclose their holdings publicly. Even more critically, these swaps were highly leveraged. Archegos borrowed heavily from multiple prime brokers' investment banks like Credit Suisse, Nomura, Goldman Sachs, and Morgan Stanley to amplify their bets. For every dollar Archegos put in, they were often controlling $10 or even $20 of stock. The prime brokers, eager for Archegos' lucrative trading commissions, provided this leverage without a full understanding of Hwang's total exposure. Each bank only saw a piece of the puzzle, unaware of the colossal, interconnected web of swaps Archegos had woven across the market. This created a dangerous illusion. To any single bank, Archegos' positions appeared manageable. But in aggregate, Hwang was building concentrated, highly leveraged bets on companies like Viacom CBS, Discovery, and several Chinese tech giants. His portfolio swelled to an estimated $160 billion in assets. The first cracks appeared in March 2021. Viacom CBS, one of Archegos' largest holdings, announced a secondary stock offering. This diluted the stock, causing its price to drop. Then Discovery, another major Archegos bet, also began to fall. As the stock prices declined, the value of Archegos' underlying positions plummeted. This triggered margin calls from the prime brokers. A margin call is a demand from the broker for the investor to deposit additional funds to cover potential losses. Archegos, with its enormous leverage, simply couldn't meet these calls. The dominoes began to fall. On Friday, March 26, 2021, the banks began to liquidate Archegos' positions. It wasn't an orderly sale, it was a desperate scramble. Goldman Sachs and Morgan Stanley, moving swiftly, were able to offload much of their Archegos exposure with minimal losses. They recognized the systemic risk and acted decisively. But others, like Credit Suisse and Nomura, were slower to react. The market was flooded with blocks of shares from companies like Viacom CBS, Discovery, Tencent Music, and Beidou. The sheer volume of these sales sent the stock prices of these companies spiraling downwards, exacerbating the problem for the remaining banks. By the time the dust settled, the losses were staggering. Credit Suisse alone reported a loss of $5 billion. Nomura lost nearly $3 billion. Other banks, while less impacted, still felt the sting of the Archegos implosion. The total estimated losses across the financial industry topped $10 billion, though some estimates place the figure higher. It was a stark reminder of the hidden risks lurking within the unregulated corners of the financial system, particularly family offices. Bill H. Wang himself was arrested in April 2022 and charged with racketeering conspiracy, securities fraud, and wire fraud. Prosecutors alleged he manipulated stock prices and misled banks about his true exposure. The Archegos meltdown served as a powerful cautionary tale. It highlighted the dangers of opaque financial instruments, excessive leverage, and the systemic risks posed by entities operating outside strict regulatory frameworks. It also exposed a fundamental flaw in risk management at some of the world's most sophisticated financial institutions, revealing how easy it was for a single, secretive family office to create a cascade of losses across global markets. The story of Archegos isn't just about financial instruments or market mechanics. It's about the relentless pursuit of wealth, the allure of unchecked ambition, and the devastating consequences when those forces collide with the delicate balance of the global economy. To understand another hidden financial danger, watch our deep dive into the collapse of long-term capital management.